I think you'd agree with me that how you say something means a lot for how your body reacts to that. Words matter, and the way that we perceive specific words or say specific words actually makes a difference in what we do and how we move forward on things. So you're probably thinking this sounds like a boring video, but I assure you it's not, because we're going to bring it all full circle for how you can be your own bank. But being your own bank is just as much about your mental attitude and how you look at things as it is about the physical act of what you do with your money. Now, before we get into this, I want to make sure you understand that the Be Your Bank methodology that we're going to talk about is all derived from Nelson Nash's book, Becoming Your Own Bank, where he basically outlined what the infinite banking concept was. And the infinite banking concept, for all of you that don't know, it's the process, not a product, the process of taking back the banking functions in your life. Just in the sheer definition of IBC are a lot of things that I said that a lot of times requires you to think about something different. So that's what we're going to do in this video. We are literally going to unravel the mysteries around the wording when it comes to you becoming your own bank. All right. Now, as we dive into this, I want to open up with one particular thing, and I want you to tell me just real quick, right down in the chat, what comes to your mind. BYOB. Okay, put it in the chat. What do you think? Oh, you dirty dogs. You thought it meant bring your own beer. Yep, back in the high school and college days, that's what it meant. BYOB. You didn't even think about it, right? Bring your own beer. But as you grew up a little bit, some of you were thinking, oh, I know it's bring your own beer, bring your own babe, bring your own something. What is he talking about? How about be your own bank? Now, when you think of BYOB and you think of bring your own beer, you know what that means. You stop at the convenience store or the beer store and you grab yourself a 6-pack, 12-pack, maybe a 24-pack, and you bring that to the party. You got to bring that beer yourself. But when you think of being your own bank, what do you think about? Don't you think about mimicking what a bank does? Don't you think about doing what you traditionally would give up to a traditional bank and just bringing that in-house to your own family and being your own bank? We're going to talk about some of those things. But before we do that, why don't we talk about how you need to subscribe to this channel. So hit that little subscription button, and also right up at the top, smash that alerts button. It's a little bell. It kind of doesn't look like this, but you can kind of, you can do this to it. Punch your screen. It might bloody your knuckles, but it's okay. Sorry. Let's get back into the terminology. IBC, Infinite Banking Concepts. BYOB, be your own banker. But what else? If you're going to be your own banker, you're probably thinking, well, I need a machine to run my money through. Because if you're going to be the bank, well, then you can't use the traditional bank's bank account, right? Not really. Because if you put your money into someone else's bank, you take your hard-earned money and you deposit it in somebody else's bank. What does that bank do? Does the bank take your hard-earned money and put it in a little box with your name on it back in the vault? Oh, silly you. You only wish. No, the bank actually takes the money that you gave up control of by putting in the bank account, and they then say, hey, Jordan, you need some money? Great. 8%, non-secured. There you go. They take your money and they make your money go to work for them. And then what do they make? Interest. But what else do they make? A spread. So this is where words matter. Spread. What comes to your mind? Please get your head out of the gutter. Thank you. You might think of spreading butter on your toast. You might think of cream cheese. Oh, that sounds good, right? All different flavors. They got blueberry cream cheese, regular cream cheese, salty cream cheese, chime. Anyway, I'm a little hungry. It's lunchtime. But when we talk about the spread when it comes to banking, we talk about the difference between what the bank pays you and what the bank earns on that money that they made go to work for them. That's the good spread. Better than any blueberry cream cheese you're ever going to put on that toasted bagel. That spread is called pure money multiplication. So let's just do some simple math. If a bank pays you 3% on the money that you gave them, you got 3%. That's what they pay you on your money. But the bank goes out and lends that money out at 10% for a car loan. How much was that frothy spread? 7, right? 10 minus 3 equals a spread of 7. But you see, when I first said spread, some of you had well, I'm not going to say it's a bad vision, but you got to get your head out of the gutter. Some of you were really hungry and thinking about cream cheese and bagels and toast. And some of you maybe were off in left field and I don't even know what the heck you were thinking about. But that's the spread we're going to talk about when it comes to being your own bank. So now the bank is making that spread. So to be your own bank, wouldn't we just take the money that we would normally give to a traditional bank, but instead of giving up control of it to them, wouldn't we just change one thing, and that's where our money goes first, and put it into a machine where we can make the spread? So let me talk to you about that. We take our money and we put it into a specially designed and engineered whole life. Now, the first thing you guys are thinking of is another term called premiums. Most people, when they put money into their life insurance policy, they think of it as a premium, which in their mind, that little tick-tock, tick-tock, tick-tock is bad. Money, premium, expense. That's what you're thinking. Those premiums, you're thinking they're just gone forever. You can't get those back. Oh my God, that's a bad thing. But let's see. When you're being your own bank and we're using a specially designed and engineered whole life, we change that from premium to premium deposit. Why? Well, because we're making a deposit into a specially designed whole life in which then we're going to then take the money out and use it to make more money. So therefore, you can't look at that as a premium expense like you would with your life insurance, your car insurance, your homeowner's insurance, or Dave Ramsey's special term insurance. Okay, those are all premiums that you don't like. But we are being the bank, so ours are premium deposits. It's all framing. And in your mind, you are creating a banking system. You are not opening a specially designed and engineered whole life. Even though that's what you're doing, in your mind, you have to think like a bank. That policy represents one deposit account within my banking system in which I control all of it. Then, just like that bank did, what you do from your banking system is you find someone like Jordan who needs a loan. And you then take that money from your policy and you give it to Jordan. But when you took the money from your bank, you have to think like a bank. When a bank gives money to Jordan, what do? They issue him a loan, right? Loan. So loan good for bank, loan asset for bank, loan money for bank. Talking to you like you would in the Stone Age, but over here in your bank, the specially designed whole life, we're taking a loan from the insurance company. Why? Well, because the insurance company will give us a loan from their general account and then allow us to use their money, i.e., which is our death benefit that they're giving us. They're just giving it to us before we die. And then I give it to Jordan. Now keep the numbers the same. Let's say Jordan pays us 8%. Let's say our policy is making 5.5%. And let's say the loan interest rate is 5%. I just gave you a lot of numbers. But let's just do the simple ones. If the loan from the insurance company costs us 5% simple, and we then loan the money to Jordan at 8%, what is in between that? Yeah, the cream cheese. That's the spread. 8 minus 5 is 3. You made a spread of 3. Is it as much as the bank? No, but you're not criminal. You're not creating money out of thin air called fractional reserve banking. That's illegal. And if you did that, you'd go to jail. But here, you are doing the same thing and you are making a spread. So Jordan then pays you interest back, which covers the cost for borrowing the money from the insurance company. But here's the other thing. There's another spread that we didn't talk about. It gets even better. Your money never left your account. How much was that specially designed whole life paying you? 5.5%. So they're paying you 5.5% compounding interest. But let's add one more word, uninterrupted. So when you think of uninterrupted, what do you think about? Well, you can think about a lot of things. DM me what you think. Uninterrupted. It just means there's nothing interrupting it. It means there's nothing stopping it. It just continuously and perpetually continues, right? Uninterrupted. So if we add uninterrupted to compounding interest, what happens? Good things. math actually happens and your money continues to grow and grow and grow. But you see, all we're doing, folks, is we're doing exactly the same thing as a bank, but we're looking at the words that we call things and we're using them in a different way. Premiums are now premium deposits. Loans are actually now assets to you, because when you take a loan from your policy to give to Jordan, that's good because you're making a spread, which makes it an asset, not a liability. See, banks are masters of taking liabilities and turning them into assets. You see, when you go to a traditional bank and you make a deposit into that bank, that deposit feels good to you. The same way, a premium deposit into your specially designed whole life, your banking system, should feel good to you. Back over to the regular bank. We make a deposit into the bank. The bank then makes that money go to work for them by lending that money out. And when they lend that money out, they lend it out at a higher interest rate, making a spread, an arbitrage, as some might call it. That's a good thing, right? So all we're doing is we're doing the same things as a bank, but we're changing how we look at the terminology. Now, the other thing too that I want to talk about is the vehicle. What are we using? Well, we're using a specially designed and engineered whole life insurance policy from a mutually owned company. Mutually owned means no stock market, no shareholders. A mutually owned insurance company means that you are technically an owner of the insurance company in a roundabout way because you're participating in their dividends. That's right, you're participating. It's a participating whole life insurance policy from a mutually owned company that pays dividends. So all those words matter in what we're talking about. But the whole life is what in your banking system? It's a tool, right? It's a machine. It's a machine that we put money in and we take money out of. That's all it is. And in doing that, it allows our money to continuously and forever earn uninterrupted compounding interest. You see, all we're doing is thinking about the exact same thing, but we're looking at it differently. Words matter. And right in the name of that product, whole life, bad. Dave Ramsey says bad. Susie Orman says bad. Lots of people say whole life bad. No, you should buy term and invest the difference. All the things come around. But you'll notice I never said regular whole life, off-the-shelf whole life. I said this is a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. Very much like banks, traditional banks, the ones we were talking about earlier. Do you know what the #1 purchaser of whole life insurance in the world is? None other than traditional banks. Look it up. Go online, type in BOLI, B-O-L-I, bank-owned life insurance. What you'll find is that banks own more whole life than anybody else. The top 5 banks as of a few years ago had $75 billion in whole life insurance. That's where their tier 1 capital goes. It goes to whole life and also treasury bonds because they're both guaranteed. And there's another word. When I say guaranteed, if I sold you a car and I said this car is guaranteed to never break down, what would you think? Well, you'd think I'm lying to you. There's no car out there that's guaranteed to never break down. But if I convinced you enough, you'd be like, wow, never had a car that was guaranteed to never break down. You'd be psyched. And when it broke down, you'd be really disappointed. So guarantees are guarantees are guarantees. So if you're gonna get a guarantee, make sure you get it from a company that can back it up, like a giant top 5 mutually owned life insurance company. They're massive. Look at their balance sheets. That all matters. Those words matter, and you need to pay attention to them. But also death benefit. You always look at a death benefit as kind of a necessary thing because you want to protect your family, but not a good thing because you got to die to get that death benefit. But you see, the way we're using that specially designed whole life is you get to use the death benefit while you're living, up to the amount of cash value you have in the policy. So now all of a sudden you're looking at that death benefit that once was like, I don't want to die, to now being like, holy cow, the insurance company will allow me to use some of my death benefit while I'm living, and because of that, my cash value just collateralizes the loan and never leaves my account. I get to earn uninterrupted compounding interest. How come everybody's not doing this? Well, because not everybody knows this. But then when you think about the death benefit, you should also be thinking legacy. You should be thinking not that you're dying to get the death benefit, but you should be thinking that someday the inevitable will happen where you will graduate and go on to a better place called heaven or whatever you believe in. And at that point in time, the life insurance company will pay a tax-free death benefit to your family. which will enable your family to continue their lifestyle, to maintain their living that they were used to while you were here, if you're the breadwinner. So now you're gone, but your family doesn't have to suffer. Well, they're going to suffer because they're going to cry that you're no longer here, but you took care of them financially. So when you think of death benefit, don't think of it as bad. Think of it as it's your legacy. It's how you give when you're no longer here. I could go on for days with this stuff, but I really just wanted to give you an idea of how the infinite banking concept works, but the terminology behind it and how it's so much about your mindset. I'm going to leave you with one video, and I want you to watch this video. It's called The Backward Bicycle. It's going to be right here. So if you liked this video, I want you to watch this one. Even though it's not one of mine, it's called The Backward Bicycle. It will show you what I'm referring to about changing the way you think about things. Because remember, everything I just showed you about the infinite banking concept requires you to change one thing, and that is where your money goes first. And if you can change that one thing, you'll never go back to the old way of doing things. Thanks for joining me for another episode. We'll see you next time.